Hi everyone, my name is Jern Vince Angarangay Ragindin and I am tasked to report about the options and the foreign exchange market. So before we go further, let us first know what is options. So options refers to a specific instrument that is based on the value of underlying securities such as stock. An options contract offers the buyer the opportunity to buy or sell depending on the type of contract they hold the underlying asset. So options are a versatile financial product. It has call options that allows the holder to buy the asset at a stated price within a specific time frame, and put options allows the holder to sell the asset at a stated price within a specific time frame. So the next one is the option speculations. It allows trader to hold a leveraged position in an asset at a lower cost than buying shares of the cost. First is American options. It can be exercised anytime before the expiration date of the option, and there are European options that can only be exercised on the expiration of date or the exercise date. So for my example here, let us assume that if an option has a premium of 35 cents per contract, buying one option costs $35, which is my answer. So one one option is usually equivalent to 100 shares. So I use 100 here and point times 0.35, which is its premium. So I get the $35 answer. So you just get to compute it. Next is option spread. Option spread are strategies that use various combinations of buying and selling different options for the desired risk-return profile. So, how does option works? It allows investors to speculate on or hedge against the volatility of an underlying stock. Its advantage is can be very useful as a source of leverage and risk hedging. The disadvantage is that they are complex and difficult to price. So what I explained was just a review because I believe that it is already explained by Asha Ote. It's just a short review for options. Now let us proceed to foreign exchange market. So I have a fundamental fact. And this fact is that every country issues different currencies, and these currencies change in value quickly, substantially, and without warning. But what affects these changes? So the factors affecting these changes are first the economic development of a country and the country's response to its political events. Now let's discuss Euro. Euro was given birth on January 4 of 1999 with only 11 countries adopting it that time. But supposedly, it was the economic currency unit that they'll be using. But the Germans didn't approve of it as they think that it is a weak currency for them to use. And now let's proceed to the foreign exchange rate. So let's define first the exchange rate. So exchange rate is defined as the amount of one currency that can be exchanged for a unit of another currency. Normally, it is the price of a specific currency to a different currency. Like for example, we have here the amount of US dollars to acquire 1 peso. So, bale, ano yung ilan yung kailangan natin na US dollars para makakuha tayo ng isang peso. And the amount of peso necessary to acquire $1. So, baliktad lang, ilan yung kailangan natin na peso para makakuha tayo ng isang dollar. So, sa foreign exchange market, meron din pala tayong mga quotations. So, ano itong mga quotations na to? So, foreign exchange quotations can either be direct or indirect. Now, let us define direct quotation. Direct quotation is the number of units of a local currency exchangeable for 1 unit of a foreign currency. Sa last slide ko, nag-example ako na ilan yung kailangan natin na peso para makakuha tayo ng isang US dollar is an example of a direct quotation. Now, indirect quotation is the number of units of a foreign currency that can be exchanged for 1 unit of a local currency. Sa last slide ko din, meron din akong example na kung ilan yung kailangan natin na US dollar to exchange for 1 peso. And that is an example of indirect quotation. Now let me give you an example. So, dito sa Pilipinas, ang halaga ng isang dollar in peso is 53. So, 53.3236. And kailangan mo na US dollar para makakuha ng isang peso is 0.04. Meaning, sa direct quotation, kailangan natin ng 53 pesos, 0.3236 para maka-exchange tayo ng isang US dollar. On the other hand, sa indirect quotation, kailangan lang natin ng 4 cents of US dollar para makakuha tayo ng isang peso. And now, let's move on to foreign exchange risk. So, foreign exchange risk is the possibility of an entity to be affected by a variation in the exchange rate between its local currency and the currency used in a transaction with a foreign country. If the foreign currency declines in value relative to the local currency, which the local currency appreciates, the dollar of the cash flows will be proportionately less, leading to foreign exchange risk. Moving on, we have the spot markets. Spot markets is the market for settlement of a foreign exchange transaction. And spot exchange rates is the adjustment made to compensate for a relative inflation rate. And this inflation is called, this adjustment is called the purchasing power parity. Now, we have the American terms and the European terms. American terms quoting in terms of US dollar per unit of foreign currency, and European terms quoting in terms of the number of units of the foreign currency per US dollar. We also have cross rates. Barred or blocked by any government restrictions, riskless arbitrage will assure that the exchange rate of between two countries would be the same in both countries. Computing rates in where X and Y represents two countries inferred from their exchange rate with US dollar is called the theoretical cross rates. So I have here the formula on how to solve for the theoretical cross rates. So quote in American terms of currency X divided by quote in American terms of currency Y, where X and Y represents the country's currencies, which can be defined as which can be quoted in US terms or European terms, as I discussed earlier. So the example I have here is in American terms, the dollar per unit per peso and baht is 0.018 and 0.028 respectively. So to get the theoretical cross rates for them to be equal in both countries, we divide 0.018 divided by 0.028, which is the 0.6428 baht per peso. So next is 0.028 divided by 0.018 is equal to 1.555 peso per baht. In the real world, it is rare that the theoretical cross rate as computed from actual dealer dollar exchange rate quotes will differ from the actual cross rate quoted by dealers. When the discrepancy is large by a comparison with the transaction cost of buying and selling the currencies, a riskless arbitrage opportunity arises. Arbitraging to take advantage of cross-rate mispricing is called triangular arbitrage. So named because it involves position in three currencies, the US dollar and the two foreign currencies. The arbitrage keeps the actual cross rates in line with theoretical cross rates. Now, let us define what those dealers is. Baka isipin nyo kasi na yung dealers na minimin ko is yung dealer ng charot. So, dealers is the foreign exchange market, is an over-the-counter market that operates 24 hours a day. So, dealers in the foreign exchange market realize revenue from one or more sources. First is the bid-ask spread, the commissions charged on the foreign exchange transactions, and 3, the trading profits. We have instruments for hedging foreign exchange risk, and we have 4 instruments are available to borrowers and investors to protect against adverse foreign exchange rate movements. First, we have currency forward contracts, currency futures contracts, currency options, and the currency swaps. Now let us define the currency forward contracts. Forward contracts is where one party agrees to buy the underlying and another party agrees to sell that same underlying for a specific price at designated date in the future. Here we consider forward contracts in which the underlying is foreign exchange. So, interest rate parity is the relationship among the spot exchange rate, the interest rates in two countries, and the forward rate. Covered interest arbitrage, the arbitrage process that forces interest rate parity is called covered interest arbitrage. Now, I have here the formula on how to compute the interest rate parity, where 1 is times the 1 plus I sub A is equal to 1 divided by S times 1 plus I sub B times F, where I amounts of A's currency to be invested for a time period of length T, S, spot exchange rate price of foreign currency in terms of domestic currency, F is the period forward rate price of foreign currency periods from now, IA, interest rate on an investment maturing at a time in country A, and IN is interest rate on an investment maturing at a time in country B. So let us know what is the link between euro currency market and forward prices. So euro currency market, the name of unregulated and informal market for bank deposits and bank loans denominated in currency other than that of the country where the bank initiating the transaction is located. Now let's move on to currency future contracts. Currency future contracts, also known as FX future, is a futures contract to exchange one currency for another at a specified date in the future at a price that is fixed on the purchase date. Currency option contracts is an agreement that gives investors the right, but not the obligation, to buy or sell a currency futures contract on a future date at a fixed price. We also have currency swaps, where currency swap is an interest rate derivative. The counterparties exchange given amounts in the two currencies. Currency coupon swaps, currency swaps in which one of the parties pays a fixed rate and the counterparty a floating rate. So that's all for my report. Thank you so much for listening. I hope you learned a lot in watching this video. Thank you.